All right, in this presentation, we'll be discussing auditing cash. The key accounts when you're dealing with cash are usually accounts receivable because that's the major inflow of money into a business is those credit sales. Now, if you're in a cash business like a restaurant or something like that, then you might see more coming in from cash sales. So there's extra controls that need to be around that. You'll see interest revenue come in. You also see the various expenses that are used to buy things. But that's why accounts payable should be also on this list because a lot of times those expenses are put into payables and then cash is then released to pay off those payables. You'll move money between different cash accounts a lot of times, usually to try to maximize whatever interest you've got, keeping things in savings as best as possible before you move them over to a checking account, which usually doesn't bear interest in it. And then you'll also see transactions between investments or marketable securities. When it comes to cash, there's a few key audit assertions. First off is existence. Does that cash account really exist? Is there a bank statement? Is it a valid bank? All these things to make sure that it really does exist. Next would be completeness. Are all the transactions going in and out of the general ledger for that cash account as you would expect? On the flip side of that, when you look at the bank statement, are all the transactions going in and out of the bank statement as reflected on the general ledger? Next is rights and obligations. Do they actually own that account? Are there loan covenants on that account that put restrictions on it? Next would be valuation. What if it's foreign currency in a foreign bank? Has it been translated properly so that the right value is reflected on the financial statements? And finally, the presentation and disclosure, in case there are things that do need to be disclosed or presented differently, especially when it comes to loan covenants. When it comes to cash, there are lots of inherent risks. One of the biggest ones is the volume of activity. You'll go into a client to do an audit and you'll see tons of transactions, lots of in and outs, maybe even between accounts, maybe even between subsidiary companies. I mean, if you look at some of the car dealerships around, you'll notice that a lot of them have the same name, yet they'll have Dodge, Ford, Subaru, yet they have all the same names. Well, there's a lot of transfers of both cars and money that go between those uh, companies. So that's something that can be overwhelming at times. Next would be liquidity, the ability to turn that cash or move that cash around, and it might make it easier to steal. Next would be automated systems. There's a lot of auto pays out there, EFT transactions, lock boxes, which are when customers make payments to a bank and they go to a particular lockbox that will then flow activity into the cash account of your client. Online banking now makes it even easier for people to do certain transactions, so you want to make sure there's restrictions on those. And then even payroll. You have a company like Paychex or ADP that will automatically sweep out payroll, both the net pay for the employees and the taxes for the government on a weekly basis or biweekly basis, depending on when they're doing payroll. You've got debt covenants that need to be revealed to you so that you know if there's a required cash balance. So let's say you've got a large credit line that the company may have. So that's one of the indicators for a debt covenant is potentially a credit line that then a bank will have in its wording, you must keep $50,000 in your cash at all times, or we will do something related to the debt or the credit line. And finally, cash is just susceptible to a lot of outright theft, whether it's the money coming into the account through skimming schemes, which we'll talk about in a minute, and also when someone who has the ability to write checks or has that signature stamp, they can figure out ways to divert cash out of the bank accounts into their own accounts or even set up fake accounts with the company's name on it that they have complete control over. So these are all things that you worry about when it comes to cash. Common schemes when it comes to cash is an employee might purchase company merchandise at a special unauthorized discount. So what they'll do is they'll use potentially that cash register, or if they can do behind the scenes work to do this, they'll hit special discounts that they're not entitled to. But one of the common things that I'll see is you might have a couple friends come in and you'll hit your employee discount, might be a family discount or whatever for those individuals, and they'll take that discount even though they're not technically supposed to do that. Employee can also steal cash before it actually gets into the accounting system, and that would be called skimming. So again, the bartender situation where they tell the individual that it's $10, but they only charge $6 in the cash register and they pocket the other $4. That's skimming. Or they might do that $10, charge them $10, then hit a special discount on the register and make sure they uh, know how much money that they can take out of the register at the end of the night. They could also falsely void or credit a sale and steal the cash. So, oh, we got that $10 drink. Thank you for the $10. They enter that and then they void it and then they pocket that $10. Employee gets a check written to a fictitious vendor that they own. So they might put in their own company if they have the ability to do that. Write a check every now and then, hopefully try to get under the radar is what they're trying to do, or create a fictitious service, fictitious invoice, get that paid through the system somehow. That's how an employee could get those fictitious vendors set up and have checks paid out to them. Employee payments from customers and purposely misapply those payments to different accounts to try to hide their theft of cash. So they're constantly manipulating the accounts of customers, hoping that no one really catches on. This usually happens in large companies that have a lot of movement of cash that people have a hard time keeping track of, yet the individual has enough ability to take that cash and somehow convert it, or those checks and somehow convert it. An example of this is a property tax division within a large multinational company. The individual would purposefully overpay the property taxes. So when the municipality would call back and say, we need to issue a refund check for your overpayment, he had set up another business with a very similar name to the company with property management at the end of it and told them they needed that check written to that property management company that was really his company. So every time they overpaid their property taxes, those refund checks would get diverted into his own special setup cash account. Typical controls related to cash are segregation of duties. That's the big one. Again, that's where we make sure that the tasks are split up amongst people so that key functions don't overlap, so that an individual doesn't have the ability to set up a vendor, input an invoice, approve that invoice for payment. So those are key areas that we separate amongst employees to try to get some control related to the cash. Another one is positive pay. What positive pay is after the checks have been approved for payment and cut for payment, a file is delivered to the bank. It usually has just the check numbers and the amounts on it. So that if anyone tries to steal that check and divert that check, increase that amount, anything like that, it will bounce out in the bank system and say they can't honor that check. For an additional fee, you can actually get it at the payee level, meaning if they do white out a name and put another name on it, that bank will identify the fact that, oh, that's not who that was the intended payee on that check, so they'll bounce that also. There's also computer controls and edit checks within systems now that help prevent diversion of cash, and even a lot of times the online banking won't allow you, without special rules, to be able to do money moves to other companies outside of what you control in your bank account. Authorizations. Authorizations approvals of the check runs. You could also have workflow approvals so that when invoices come through and it hits certain levels of the volume or actually dollars, and a manager might be able to approve that. If the dollar amount is higher than that, then maybe his superior would need to approve it. But usually it's set up in the system, again, like a computer check, to authorize that payment for release. You could also have EFT agreements, electronic fund agreements that are out there that are authorizations that are allowed to then move money uh, to different accounts or create auto pays for like your electric bill or whatever to move money out of the cash account. You should have procedures around doing bank recs, procedures around disbursements, things like that, so that everyone is very aware of how the process of cash coming in and cash going out and that reconciliation happens. Pre-numbered documents are another key control. Check numbers. One of the things you want to look for are missing checks, or gaps, I should say. And if you got 1, 2, 3, 4, and then all of a sudden you jump to 20, 30, 21, 22, what happened to those checks that are missing? You will also do that for invoices and POs and things like that, so that you have pre-numbered items out there so that you'll always be, whether it's cash cycle or other cycles, you can keep track of things. So pre-numbered documents are a good control. The employees, you want to have good, competent, trained employees that know what they're doing so that they can both be efficient and effective in both doing their work and identifying any problems that happen. And then you want a periodic review, or if the company's large enough, an internal audit. When it comes to typical controls for petty cash, you want to make sure that you have a written policy and you're applying those procedures on how it's both replenished and how it exits out to individuals who are using it. So you want to limit access to that petty cash, whether it's in a locked box in someone's desk, or it's in a vault or some sort of storage that makes it very difficult for others to have access to it. You need receipts for anything that comes out of that petty cash, and then those receipts are used to put together replenishment requests. So the checks that are written to replenish that cash should have the detail and all the receipts associated with that replenishment, and they should add up to total that check that's used for replenishment. And finally, you got to audit the petty cash. So you want to do a surprise audit once in a while to make sure the individual in control of that is doing all their tasks properly. When it comes to cash, some of the analytical procedures you should do are comparing cash balances with past years and budgets. It's amazing how, if you trended out the monthly cash flow from one year to previous years, you'll see patterns that are usually very similar. But you'll want to identify unexpected spikes or lows during the year and understand what they're comprised of, and do they seem reasonable. You're going to compute trends and estimates on interest returns. Are they what you expect? You'll analyze those cash balances against debt loans or covenants to make sure that we haven't slipped below the requirements that could potentially incur penalties or even potentially loss of that credit line. You're going to compute cash-related ratios like the quick ratio or the current ratio. Compare it to industries, compare it to prior years of that company. Do they make sense? You'll graph the cash balance changes against profitability. So it only makes sense that if we're becoming more profitable, then theoretically our cash should go up too. Obviously, there could be differences in cash collections because of timing and accounts, whether you've got credit sales on accounts receivables and maybe there's been problems paying. And so that may be some differences in it. But in general, you should see cash balance changes kind of go similar in a graphing standpoint to profitability. So indicators of possible fraud when it comes to cash are unusual large cash transactions, especially unexpected unusual large cash transactions. You're also going to, again, look at cash flow related to profitability, and if there are some significantly different patterns that don't get explained through collections, then that's something you want to investigate. Are consistent profits happening, but cash flows are in the decline? That's a problem. Unexpected increases in petty cash or unusually frequent replenishments of that petty cash. Reductions in accounts receivable collections while sales are stable or growing. So is there a problem with the industry at that time, or is it something related to that cash collections that's a problem? If there are significant changes in cash flow compared to prior years. And then finally, if there's just a lot of increased transfers, especially to unfamiliar or unexpected accounts. So some key audit substantive tests related to cash include inspecting those bank recs, you know, check for approvals, check for timeliness. Have they been signed off in a timely manner by someone who's reviewed it? Watch out for old reconciliation items, especially old deposits in transit. They are a sign of fraud or duplicated entries. I'll walk into a QuickBooks a system that nobody's looked at in a little while. I'll look at the rec and I'll see these old deposits that haven't cleared. And 9 times out of 10, it's not fraud, but it usually means they've accidentally duplicated some sort of entry. They've in QuickBooks you have multiple ways to enter a deposit. So they might have done it through a journal entry, done it through a regular deposit, maybe do it through a receipt from a customer somehow that has duplicated that. So that's just clearing up messy activities and procedures. So you're going to reperform those bank reconciliations at times to make sure they've done them right, make sure they add up right, make sure it makes sense. You want to obtain bank cutoff statements to verify that bank rec also. Sometimes bank statements cross over periods. They're not at the end of the month, they're in the middle of the month. So you want to make sure that what you're seeing is for the time period that you're looking at. You'll obtain bank confirmations with banks for all accounts, especially from new or unexpected accounts. So if they've been dealing with Bank of America and that's where you've been getting the confirms, but all of a sudden you see a little transfer to a Wells Fargo account, you're going to want to make sure you do a bank confirm from Wells Fargo. Also, you're going to review and prepare an interbank transfer schedule to verify the expected results. Not only do I want to see that the money has gone out of one account into another account, but you want to make sure that they haven't done something before year end and recorded it as if it was after year end, where the entity or joint venture or subsidiary that they've got has recorded that before year end. So it looks like it's still in your cash at year end, but then it's also in their cash at year end. So you're looking at timing of these transfer schedules. You're going to scrutinize checks made out to cash or some unusual vendor names that you're not used to seeing. You're going to verify with the bank all authorized individuals with access to that cash account. Are only the people that are supposed to have access on that list, or do other people that aren't supposed to have access or that surprise you, or maybe old employees that aren't even there anymore still have access to that cash account? So now that we've gone through all our inherent risks and procedures and concerns related to cash, let's revisit the assertions. So existence, you're going to have bank confirms. You're going to be looking at bank statements. You'll look at online statements to make sure that cash exists and is out there as they say. When it comes to completeness again, are all the transactions in the accounting system, have they shown up on the bank statement? And also have all of the bank statement transactions that you see on the statements been reflected in the accounting system? So it's, is one in the other and the other. If something's missing from one, there might be a concern. Cut-off statements to ensure that you've got that proper period end timing of all those financial transactions, especially if you've got interbank transfers within subsidiaries or joint ventures. You're going to look up those rights and obligations. Is the bank account really owned by the client? That bank confirmation and those statements should help you with that. The valuation, again, have you properly valued foreign currencies in foreign banks on the financial statements? And then presentation and disclosure, or any restrictions to that cash that need to be disclosed. Let's take a minute to look at some of these tests like the bank confirm. Old school, mailing it out. This is what the old form looked like. You'd put the institution on there. You'd say what client that you were auditing and They'd come back with the accounts name, the account numbers, if there's an interest rate, what that balance was at 12/31 or whatever the year end is. And if there are any loans out there, your customer or your client would sign that, and then the bank would then fill in those numbers and sign that. So that was the old school bank record. Now you can do a lot of these things electronically and online. So like myconfirmation.com, you can send that out and get that verified right back to you. There's a cost related to that, where the old school was just a stamp. The new school, there's a cost for every confirmation that you send out. No, we also want to just briefly discuss marketable securities because that's usually what's linked in with cash many times. So you're going to review the client's schedule of marketable securities. What do they have out there? Verify the existence of those securities either with statements or confirmations with the securities agent that they deal with. You're going to reconcile that with the ledger and make sure schedule foots adds up properly, and just don't just trust paper or Excel. Make sure that there that it does really total up the way it's supposed to. Verify whether there's any restrictions that exist on those securities. Verify current value with some sort of financial reporting service. Like a lot of times I can go on to Yahoo, or there's other things out there that you can actually see historically what the value of that was at the year end that you're auditing. You can make sure that accrued interest or even any unrealized holding gains or losses are recorded and reflected properly on the financial statements, and then obtain a memo or any other documentation related to, the process and procedures and the objectives of the marketable securities that the company's got. Thought I'd have a few slides here on QuickBooks so that, especially if you're dealing with QuickBooks clients, you'll know some key things related to that. Plus, most systems are set up with the same methodology or mentality as QuickBooks, so it's kind of easy to use QuickBooks as an example. The key things you'll usually be able to look at is the deposits that get recorded, any checks that were written, and then you should be able to get any kind of reconciling of those accounts and reports that you want. So this is the flow that QuickBooks usually presents when it opens up. When it comes to cash, most systems like QuickBooks have both banking uh, options that you can choose, and you can see there you can make deposits, you can transfer funds, you can reconcile the account, write checks, look at the register. You can even have automated bank feeds that feed right into the QuickBooks system, or again feed into the other systems that are out there. There's lots of reports, banking reports. You can see all the deposit details, check details, missing checks, and I'll show you some of these reports later on, but they're very helpful tools when you're doing an audit. A cash function that companies can also do is receipt of customer payments, and that has a tab across the top, or an option across the top that says customers, and you'll see received payments. One of the first places I start when I look at QuickBooks is I'll go into the reports and I'll look at company and financial reports, and I'll do the balance sheet. And usually that'll bring up the different accounts that are out there if they've got any values in them. So in this particular case, we've got a balance sheet that has the Bedrock Bank for the town of Bedrock, and we'll be looking at those accounts. But here's a little trick that I need you to remember. Uh, Sometimes accounts are made inactive, so you don't see them. Or sometimes the reports are uh, get rid of zero balances. Well, if you've got a fraudulent account out there that you in and out zero, it'll never show up on this balance sheet report. So you can customize these reports to say, show all accounts. And then you might see a cash account that pops up there as zero. You want to click on that to see if there has been any activity in that zero account, because it may have some fraud actions in there and be hidden because it's a zero balance all the time. So just one of those little side Tim certs about balance sheets and cash accounts. Now, if you click on any of those cash balances you saw at the balance sheet, it'll automatically open up a transaction detail uh, viewing for you so you can see any of the transactions that you have out there. You can also export this to Excel if you wanted to, which makes it a lot easier to work with. But you'll see that it shows usually the amount that's out there. And again, these all came from an accounts payables that were entered. So that's why you'll see accounts payable as the offsetting account to that cash account. Another area that you saw on there was a check register. That was part of the banking. When you click on that, you can view all of the items that are affecting that cash account as though you were opening up your checkbook and looking at it that way. And you can click on any of these and edit the transactions. You'll see that edit transaction uh, up there that allows you to open up the original transaction, and no matter what form it came in, whether it was a journal entry, a bill payment, through a check, or if it was a deposit, it'll open up that original transaction for you to view. So we opened up one of those check transactions, and it brings us right to the check as it was written in QuickBooks. You'll see one of the problems with QuickBooks is it is pretty easy to change things. All these areas that are open, you could change. That's why that audit trail function that I'll talk about in a little bit is really important. But if you're doing your substantive tasks and you're verifying checks, you're verifying invoices that were paid, things like that, you can actually run a report on these things. But if you wanted to see the original check itself and how it was put into QuickBooks, that's very easy to do, just like it is in many systems. Transfers that you see between accounts, they pop up all the time. And again, QuickBooks has an actual transfer function. You can see which account it went into, which account it came out of. So if you see a transaction, you're unsure, you can usually go to that date and you'll be able to potentially see where the other side of that transaction is. The transfer funds in QuickBooks does, you can put anything in that memo and it automatically fills with funds transfer. What I found too is you can't actually delete a fund transfer. You can delete checks and things like that, but you can't delete fund transfers. You have to change it to 0 if you're going to change it. But again, all these things will then come up in your audit trail. This is what a deposit can look like in QuickBooks too. So if we clicked on a deposit transaction, it would open up this deposit screen and it would show the different things that money was received for. That those are the revenue accounts that are recorded for the town of Bedrock in this case, and all the different amounts that lead up to that deposit that we should see on our bank statement of that $13,000. If you're doing sampling, and again, you should be able to get a check detail list. So, for example, QuickBooks has this check detail list. It is something that you can see. There's an Excel option. You can shoot it out into Excel, clean it up a little bit, do your data cleanup, and have just the checks and check numbers and money out there that you can then run against some sort of non-statistical sampling or sampling process to make your selections. Okay, this is something I really want you to pay attention to because these are basic uh, bank reconciliation reports you can get at QuickBooks. There's a summary that just lists the key things: beginning balance, checks and deposits, cleared balance, which that should tie out to your bank statement, and I want to get back to that in a minute. And then anything else that's been entered after that bank statement, it still shows all those things. So you'll see the ending balance, but you'll see the register balance is the other key factor. That should be the balance that you have at 12/31, 2019 in this particular case. So that's the summary section for the summary bank report. Very important. If you're having issues with the bank rec, that's where you can get into the detail and run the detail report of that, see what's in there and not in there. Sometimes I'll go to print off a summary bank rec, and that register balance that you'll see down there closer to the end of it, of $295,000 in this case, won't tie out to what I see on the actual QuickBooks General Ledger. And what that is an indicator of is after that bank rec was done, Somebody has gone in and changed a transaction or backdated a transaction, whether purposefully or accidentally. Again, you can change those dates in QuickBooks. You may accidentally be in 2020 and accidentally put 2019 in February, let's say. You just accidentally do that. You've just changed the balance in 2019 by doing that transaction, and it won't tie out to your bank reconciliation. So what you want to look for is anything that's come after this bank date, this bank reconciliation date, that has altered into the past. And it might help you uncover where there is a difference between the register balance on the reconciliation and what's actually on the general ledger of the QuickBooks for cash at 12/31. This is another helpful tool for the auditor. Again, this is a QuickBooks report, but missing checks. You'll see when missing numbers occur. So if you look at the number section kind of in the middle of the report here, you'll see 10/135, that's the first one, and then you'll see 136, but you'll see 137's missing. So these are missing checks that you want to make sure they've been voided properly. What happened to that check? Why is it missing? So it's just another little auditor check you can do with a report within QuickBooks to help you out. And finally, I've talked about the importance of the audit trail, running that audit trail report. So I run the audit trail report for anything that's been changed in the prior year. And look, lo and behold, I've got this check that was written. And if you look at the prior in the middle of the report, you'll see the word prior. It says it was written to cash for $5,000 on 12/31. But it still remains a 12/31 transaction, but the controller has gone back in. If you look at the latest transaction on January 3rd, 2020, the controller went in and changed the name to Independent Health. It's been put under health expense. So this looks like the controller wrote a check, cashed it in, changed it to Independent Health so they would hide the fact that they wrote it to cash. And unless you go back and do the audit in detail, you might not catch this. You might think, oh, that's just the normal Independent Health. Could be a fake invoice you're looking at, but the audit trail will show that it was originally written to cash. And so there's where the problem and potential embezzlement has existed in this particular case. That concludes the discussion on auditing the cash cycle. And now for a few questions.